The Australian Financial Review.
We decided to buy an investment property out west because it's much more affordable. A 2-bedroom, fresh build for sub 800.
Rent vesting is on the rise in Australia. For those wanting to get into the housing market but not being able to afford where they live, it's a pretty good solution.
As opposed to a shacky 1-bed, no windows, no parking apartment in Enmore for $1.1 million. Your money goes a lot further out west.
Take James and his partner, who live in the trendy inner Sydney suburb of Newtown, where the median house price is approaching $1.9 million.
Our current property has gone up in value, and in the next few years we'll reassess on whether or not we refinance or sell, so we can buy somewhere to live in a place we want to live.
Alongside cashed-up investors looking for somewhere to park their money and first home buyers taking advantage of a new government scheme, people like James are driving house prices ever higher. But Michelle Bullock may be about to spoil the party.
There's no relief for homeowners this morning after the Reserve Bank left interest rates on hold.
The Reserve Bank has left interest rates on hold today.
So when will we see the next rate cut?
After a surprise inflation spike, the Reserve Bank governor warned last week there may be no more rate cuts in this cycle.
So we might be waiting a full 12 months until the next move, potentially. It could just as well be likely that the next move's up than down.
Welcome to The Fin. I'm Lisa Murray. This week, economics editor John Kehoe and deputy property editor Michael Bleby on the Reserve Bank's interest rate dilemma, why the next move might be a hike, and whether that would curb the relentless rise in house prices. It's Thursday, November 13. Hi, Michael. Hi, John. Thanks for coming back on the podcast.
Good to be back, Lisa.
Hi, Lisa. It's great to be here.
John, just a few weeks ago, the Reserve Bank appeared to have inflation under control. Why was Michelle Bullock so confident at the end of last month that the economy was in relatively good shape?
Well, Lisa, the central bank's objective is to have inflation sustainably in the middle of the 2 to 3% band and also try to achieve full employment or low unemployment. And look, it seemed like the Reserve Bank was doing a pretty good job of that after we had the big inflation outbreak in the post-COVID era. Inflation in underlying terms, which is the RBA's preferred measure because it moves out some of the short-term volatility, it was tracking back towards the 2.5% midpoint of the target. And also unemployment was in the low 4s as well. So things were looking pretty good. And Michelle Bullock said herself at the Australian Business Economist dinner,
I don't want to count my chickens too soon, but what we've managed to achieve in bringing inflation back down and managing to maintain some of the gains in the labour market, for me, has been a very satisfying outcome.
But she said that only a couple of days before the stronger inflation figures came out and about a week before the Reserve Bank board met on monetary policy. She did say she wasn't counting her chickens completely. I guess she did suggest that, she wasn't absolutely calling it all over Red Rover, but she was feeling quietly confident that the RBA had or was very much on track to achieve those two dual objectives.
And Michael, that confidence had found its way into the mood in the housing market. Home buyers responding to those rate cuts had pushed house prices up higher. How much are prices rising across the country?
The latest data from research firm Cotality shows national home values rose 1.1% in October. That was the fastest monthly rate of growth in more than 2 years. And now, with still 2 months to go until the end of the year, we've already hit the national 6% gain that Commonwealth Bank economists were expecting to see this year in total. It was a slow start to the year in Sydney and Melbourne, where home values kept falling until early February, but even they're catching up.
Recent interest rate cuts are helping reignite Melbourne's property market. It's the biggest
right now in Sydney. The median house price is a whopping $1.6 million.
Since that first rate cut in February, values have gained 5.8% in Sydney and 4.7% in Melbourne.
And million-dollar homes have become really common in Australia.
Yeah, 30% of all sales last year were for homes worth $1 million or more. And this year, the national average moved above that $1 million mark. There are a lot of figures we could throw out here, but there's just one more. If you look at the last 5 years, national housing values have risen 47%. So on average, a house valued at $1.17 million now cost $800,000 5 years ago. So housing price growth accelerated in October.
All first home buyers will be able to buy with just a 5% deposit from October.
And the expansion of the federal government's First Homeowners Guarantee Scheme, which kicked off on October the 1st, has reduced the cost of getting into the housing market for that cohort of buyers.
In a bid to get more young people into the housing market sooner.
Last week, Westpac said it expected house prices to jump 9% across Australia next year. That will then be on top of the 6% this year, 5.1% in 2024, and 10.1% in 2023.
So, John, just a few days after Bullock said she didn't want to count her chickens too soon, the latest inflation figures came out and they were well above the RBA forecast. The central bank had to change course and, unsurprisingly, left rates on hold last week. Why did the RBA get that inflation forecast so wrong?
Yeah, it was a big miss for the RBA on its inflation forecast, Lisa.
Well, good afternoon, everyone. Today, as you'll see,
it was forecasting underlying inflation to be 2.6%. It ended up being 3.0%, right at the top of its target band. It's really trying to target the middle of that range over the medium term as well.
Inflation in the September quarter was higher than we were expecting in our previous forecasts.
There was a few factors for this. Look, the RBA was expecting it to be a bit higher because they got a couple of monthly reads before the big quarterly number. I knew it was going to be a bit worse than expected, but even the quarterly read of 1% or 3% in annual terms was higher than it was anticipating. There's a couple of reasons.
Now, we think some of this was driven by temporary factors such as travel costs, council rates and fuel.
Some of them, Michelle Bullock thinks, are temporary factors, and this is things like fuel, international travel, local council rates that jumped 8%. So the bank thinks that's more temporary, but there were some more persistent or sticky factors that the RBA is watching closely, particularly things like building construction costs. They're on the rise again, and she spoke about how difficult it is to get a tradie.
I don't know how many people have tried to get a tradie, perhaps, to work on their house. It's difficult.
To give an example or anecdote about how capacity constraints in the construction sector for building homes might be pushing up prices there, the wages, the materials, those sorts of things. She also pointed to the market services inflation. Now, this is things like eating out at a restaurant where wages comprise a large portion of the business's overall costs. Now, previously, when the economy was particularly weak and consumers weren't spending much during those high interest rate period over the last couple of years, businesses were absorbing these higher costs, but now they appear to be passing them on to consumers because after those 3 rate cuts we've had earlier this year, consumers are spending a little bit more on discretionary, and so businesses feel a little bit more confident about passing on those higher costs. And that's a bit of a concern for the RBA because it's what's known as cost-push inflation, businesses passing that on.
This blip in September is going to stay in the inflation numbers for basically the next 12 months. So it's going to have a 3 on it.
And so now the RBA's forecasts are for underlying inflation to be 3.2% for the first half of next year. So that's actually above the target band. They do think it's going to fall back towards the target band in the second half of next year. But you'd probably have to say that's a half glass full or optimistic reading. That's if things go right.
And Michael, it's interesting that John mentioned there the cost of tradies and the cost of housing. It's like housing is both a symptom and a cause of what's going on.
It's funny. Inflation pushes up housing costs and then housing also pushes up inflation. You know, as housing buyers and investors, we respond directly to rate cuts, not only by buying homes, but investing in the homes we already have and buying things to put in them. And that then pushes up prices across the board. In a way, this shows the oversized way that housing relative to other sectors of the economy impacts and is impacted by inflation and rates. Housing sort of is shelter, it's a basic need, but it's also the main way people build up and store wealth in this country. And then if we go back to the recent inflation numbers, the housing component of the CPI figures reflect the changing price of new housing, excluding land costs and mortgage costs. That category jumped 2.5% in September from the June quarter, making it the single largest increase of any component of the CPI. And it's one of the things exacerbating our affordability problem. Because it's more expensive to build a new home than to buy an existing one in many cases, hopeful first home buyers add to the pool of people competing for established housing rather than potentially adding to the overall stock of housing by buying a new house and land package or even a new apartment. Most things around housing are tight and getting tighter.
So, John, how worried do you think people and the central bank are about whether inflation could now get out of control?
I'd describe people, including Michelle Bullock, as alert but not alarmed about this, because they do think there's some of those temporary factors that I mentioned, but they're certainly not getting overconfident that they've completely got inflation under control. And that's why I think Michelle Bullock said there might be or there might not be any more rate cuts.
And it's possible that there's no more rate cuts. It's possible there's some more, but we didn't go up as high. We might not have to come down as far.
Previously, markets had been banking in a couple more. They've sort of been pushed back, and maybe we might be waiting a full 12 months until the next move, potentially, or somewhere around that vicinity. It could just as well be likely that the next move's up than down. If a central bank holds rates for that long, it's pretty hard to crystal ball gaze from here and predict whether the next move is really going to be up or down. One cohort of borrowers who is going to be watching this closely is property investors. They've really been piling into the market in recent months after those 3 interest rate cuts earlier in the year. And investor credit growth has been rising at its fastest pace in 10 years.
We're talking about the Reserve Bank's decision last week to leave interest rates on hold after a surprise jump in inflation. Borrowers have been expecting more rate cuts, maybe even one more this year, and now that's not on the cards. All eyes are on the housing market. John, investors have been piling into the housing market. Will they be put off by this change in the outlook for interest rates?
Lisa, my strong suspicion is maybe at the very margin. I don't think it's going to have a big dampener on the property market in the short term because rates don't appear to be going up in the foreseeable future, certainly not in the coming months. So investor loan growth jumped to over 7% in September. That's the fastest annual pace since 2015. And that's when APRA, the banking regulator, actually impose speed limit on investor loans. But it's important to say that it's not just the low interest rates that's driving up house prices and demand for credit. There's population growth because of strong immigration, a lack of supply of new homes being built. That's starting to turn around slowly, but it's going to take time. And just land scarcity, frankly, particularly for standalone housing on land as well. So I'm not that convinced investors are going to dramatically change their behaviour at auctions over the short term. It might take a little bit of heat out of it, but I think it would probably take a rate rise or two before people really cooled their heels. And if you think about it, interest rates are still pretty low. You can borrow, give or take, around about 5.5% at the moment. Historically, that's quite a low interest rate, maybe not as low as COVID, but still quite affordable for cashed-up investors, particularly those who have high incomes. So there does seem to be a bit of a herd mentality at the moment that property's a sure bet.
And that herd mentality plays out in the data. We already know investors are a big part of the market, and they now account for 38% of all mortgages. And as John said, investor loan growth's now at around the levels it was in 2015, back at a time when the regulator cooled the property market by forcing banks to slow down their lending to landlords. And in the last few weeks, the regulator's been putting banks on notice that they should have their systems ready in case they reintroduce these speed limits. So that may yet come, But one interesting difference from before is this time around, it's not just cashed-up investors piling into the market. We're seeing people buy investment properties in cheaper suburbs because they can't afford to buy where they live.
Michael, as you said earlier, the First Homeowners Deposit Scheme, which was put in place to try and address the chronic problem of housing affordability that people like James are facing, that did contribute to the pickup in house prices in October. How does it work, and will it keep boosting prices?
Just under 6,000 homes, about 1 in 10 of all homes sold last month, were bought by Australians using the Federal Labor government's expanded 5% deposit scheme to enter the market for the first time. Just under half of those were people who couldn't use the scheme before. The way it works is any first home buyer can purchase with just a 5% deposit without having to pay lenders' mortgage insurance, as the loan is underwritten by the government. Labor pledged ahead of the 2025 election to expand this scheme by scrapping means testing and creating unlimited places and lifting the maximum eligible housing price across each jurisdiction, which range from $700,000 in Hobart to $1.5 million in Sydney. Now, the government's been under some pressure to defend the policy, which economists say will only exacerbate the problems of affordability. But Housing Minister Claire O'Neil says the uptake is tracking with Treasury forecasts that prices would rise by only 0.6% after 6 years. The forecast is for 70,000 homes to be bought with this program in the first year.
What do you think, John? Will that scheme add to demand and keep pushing up prices?
I think inevitably it will. It's not the only thing pushing up house prices. There's obviously things like we've had those existing interest rate cuts, a lack of supply, strong migration, population growth. But I think the really interesting thing is that we spoke to a buyer's agent in Brisbane and quoted him in AFR Weekend saying it's not only having impact on first home buyers. So he said when the Albanese government announced in late August that it was accelerating the expansion of the scheme to start in October rather than a bit later, in the month of September, investors actually piled in anticipation of this scheme driving up house prices from October onwards once first home buyers were eligible for the more expanded scheme. And he said in certain pockets and price brackets, in a matter of 4 weeks, prices were jumping as much as 4 to 7% in some areas, which is sort of consistent with what you've seen with some economic modelling done by the economist Nicholas Gruen, admittedly for the insurance industry, who are a loser from this because people are going to get free lenders' mortgage insurance from the government instead of having to pay OMI. But he's a credible economist, and he showed that in the first year, that's where you get the big price uptick of somewhere around 5% or so. And then over 6 years, he says that flattens out once that bring forward in demand eases off. And that's where Treasury says, only over 6 years, it only pushes overall national prices up by 0.6%. But I do think in the short term, in certain pockets, price brackets and geographies, it will have a meaningful impact on prices.
So it's more people anticipating the impact of the scheme rather than the scheme itself at the beginning?
Well, I think it's both. I think initially it was investors sort of getting in, preempting what first home buyers will do, but it's also bringing forward demand from first home buyers now who are eligible for the expanded scheme.
So then both investors and first home buyers are coming into the housing market at a time when supply is crunched, and that's pushing prices up. John, in this trickier inflation environment, how focused is Michelle Bullock on house prices? I know they don't specifically target house prices, but how much is she looking at that uptick?
Look, they do keep an eye on house prices for a couple of reasons. One, if house prices are growing faster, people, homeowners, which is about 2 in 3 households, whether they don't have a mortgage or do have a mortgage they're paying down, they feel wealthier and they tend to spend a little bit more. So there's this thing called the wealth effect. If you're getting wealthy, you start to spend more. That can add to inflationary pressures in the economy. And maybe we're starting to see a little bit of that, or will in the future if prices keep rising. The other thing the RBA is watching for is financial stability issues. But rather than house prices per se, what they focus more on is actual credit growth and the riskiness of lending by banks in conjunction with APRA, the banking regulator. And so far, they're not really seeing a decline in lending standards, more risky lending like they were back around 2014 to 2018 when they sort of imposed lending restrictions on investors. Back then, there was a lot of interest-only loans. Investor credit was growing at about 10%. And so they're not seeing that same sort of risk factors in the market at the moment. But they'll continue to keep an eye on house prices. But they really do see that as mainly a responsibility for other policymakers, be it governments increasing supply, particularly at the local and state level, trying to get more housing into the market by producing red tape and zoning and planning and all those sort of regulations.
So she'll keep an eye on it, but it's one for other regulators. More broadly, do you think Bullock is doing a good job?
I think so far you'd have to say she has done a solid job as RBA governor. They did get inflation close to back towards the 2.5% target in underlying terms, not quite perfectly, but very close. You know, unemployment stayed relatively low. I know it's drifted up from about 4.2 to 4.5%. And on Thursday this week, we get an update on that. But, you know, in all honesty, I think it's too early to make a sort of a full and final judgment. This inflation cycle may still have further run. There might be more difficult decisions that they have to make. But you'd have to say, so far, so good, a solid job that Michelle Bullock is doing.
And John, you did mention the unemployment rate, which was higher than expected in the last set of figures. We've got another set of figures coming out on Thursday. If that were to go up again, would that change the way Michelle Bullock is looking at interest rates?
I think yes, in the sense that while it might not mean an immediate cut in rates, given we've just had this inflation uptick, it would make the bank very nervous and worried. But they're pretty sceptical, I've got to say, about the recent uptick in the unemployment rate to 4.5% because they look at a whole range of factors over the labour market. And they're seeing things like the rate of underemployment reduce. That means part-time workers are actually able to be working more hours because they want more hours. What's known as the quits rate is up as well. Now, that's because workers are actually more confident to quit their jobs and go and look for other work as well. So there's other factors out there in the labour market that suggest it's a bit more solid than the official unemployment rate. And the monthly rate does tend to bounce around a bit, but there's not many layoffs either that they're pointing to as well. It's more that new people coming into the labour market, be it high school graduates, university graduates, new immigrants, they're finding it a little more challenging to secure workers quickly, but it's not like there's a lot of layoffs of existing workers. Not many people getting fired or sacked at the moment beyond typical redundancy rounds that we're seeing across some sectors like banking and that.
So for now, rates are on hold and the view is that the next move next year might even be up. Is that change in the interest rate outlook going to be enough to curb the relentless rise in house prices?
Lisa, I don't think it will, certainly not for the first half of next year. If you look at the forecast of a bank like Westpac for 9% growth, that's based on the idea that the current level of activity is going to hold up for the whole year. Look, if there's a big change in the jobs market, if unemployment gets worse next year, that's obviously going to affect the market. We've also still got the problem of affordability. Even if you use the expanded home buyer guarantee scheme and you can take out a mortgage with a smaller deposit, you've still got a 95% loan that you're going to have to somehow manage to service. The weight of that hasn't gone away, so affordability is still weighing on buyers. But then again, if inflation comes back under control, Michelle Bullock starts finding it easier to hire a tradie than she may have in the past, and if the bank starts cutting rates and people start piling back in, then we're going to see a whole lot more of this, so I think we'll just need to grab our skates and buckle in for a ride.
Look, in the foreseeable future, I don't really see much ending this sort of property market bull run, barring some sort of unforeseen exogenous shock internationally, perhaps artificial intelligence wiping out a whole lot of jobs, which I think is probably unlikely in the very short term, although a risk perhaps in the medium term. I really think to really get investors and home buyers more broadly pulling back from bidding up prices, it would take probably one or two interest rate rises. The financial market's still betting on one more interest rate cut mid-next year. So I think the property market's going to continue to be strong for at least the first half of next year.
Thanks, John. Thanks, Michael.
Thanks, Lisa.
Thanks, Lisa.
Thank you for listening to The Fin. I'm Lisa Murray, with the Financial Review's economics editor John Kehoe and deputy property editor Michael Bleby. The Fin is produced by Alex Gow and Mandy Coulin. Fiona Buffini is head of premium content. Our theme is by Alex Gow. If you like the show and want to hear more, follow us and send this episode to someone you know, as it helps others find us. For more stories about markets, business and power, subscribe to the Financial Review at afr.com/subscribe. See you next week.
The Australian Financial Review.